You spend years building wealth, buying stocks, holding index funds, watching your home appreciate, and then the moment you actually try to access that wealth, the government takes a cut. That cut is the capital gains tax. And right now, the Trump administration is actively working to shrink it. This week, senior White House economic officials went on air and said the president is seriously considering two major changes. One that would reduce the tax you owe when you sell investments, and one that would eliminate the tax on your home sale entirely. These aren't fringe ideas. They're being discussed at the highest levels of the administration ahead of the 2026 midterm elections, and they have real dollar implications for anyone who owns a home, a brokerage account, or both. Now, here's why this matters even if none of this passes. Most investors don't fully understand how capital gains tax works right now, which means they're already leaving money on the table. So today, we're going to fix that. We'll cover exactly what capital gains are, what the 2026 brackets look like, what's being proposed, and who actually benefits. And finally, what the housing piece means for homeowners sitting on serious equity. By the end of this video, you'll know more about this topic than most people who've been investing for years. Welcome back to Compounding with Callie, where we compound some miles and our money. First, let's make sure we're clear on what a capital gain actually is, because this affects every investor whether they realize it or not. A capital gain is the profit you make when you sell an asset for more than you paid for it. Let's say you buy $20,000 of stock over a decade and then sell it for $70,000. That $50,000 difference is your capital gain, and that's what gets taxed. The tax rate you pay depends on how long you held the asset and your total taxable income for the year. This is where short-term versus long-term distinction matters enormously. If you sell within 12 months of buying, that's a short-term gain, taxed as ordinary income, with rates reaching as high as 37% at the top bracket. Hold for more than a year and you qualify for long-term capital gains rates, which are significantly lower. For 2026, those long-term rates are 0, 15, and 20%, depending on your total taxable income. Single filers pay 0% up to $49,000 in taxable income, 15% up to $545,000, and 20% above that. Married couples filing jointly get the 0% rate up to $98,000, 15% up to $613,000, and 20% above. That 0% bracket is something a lot of people miss entirely. A married couple with combined taxable income under $99,000 pays zero federal capital gains tax on long-term gains. If you're in the early stages of building wealth and your income falls within that threshold, you could potentially realize significant gains without owing the federal government a single dollar on them. Going back to our example, you sell a stock and pocket $50,000 gain. If your total income puts you in the 15% bracket, you owe $7,500 in federal capital gains tax on that trade. Now here's what the administration is proposing to change. The first and most discussed proposal is inflation indexing. The idea is to allow taxpayers to adjust the purchase price of their assets for inflation before calculating their taxable gain, so that only real gains, not inflationary phantom gains, are taxed. Here's how it works. Under current law, if you bought $1,000 of stock in 2005 and sold it today for $5,000, you owe capital gains tax on the full $4,000 gain. But the original $1,000 has the same purchasing power as roughly $1,600 today. Under inflation indexing, your cost basis would be adjusted to $1,600, and you only owe taxes on $3,400 instead of $4,000. Using our $20,000 stock example, say you bought it in 2015 and held it for 10 years. With roughly 30% cumulative inflation over that period, your adjusted basis rises from $20,000 to $26,000. Your taxable gain drops from $50,000 to $44,000. At 50%, that's a tax bill of $6,600 instead of $7,500, a $900 savings on that one trade. Modest for a single transaction, but significant for large investors selling assets for decades. The bill would apply to individual taxpayers on assets held more than 3 years, covering stocks, tangible property, and digital assets with the inflation adjustment calculated using the GBP price deflator. The administration is also separately discussing cutting the top long-term capital gain rate from 20% down to 15%, which would affect the highest earners. But here's the important caveat. None of this has passed. The One Big Beautiful Bill signed into law on July 4, 2025, kept the existing capital gain structure entirely intact. These are proposals being floated ahead of midterm elections, not current law. Now let's talk about housing, because this is where things get most relevant for everyday Americans. Under current law, homeowners selling a primary residence can exclude up to $250,000 in profits from capital gains tax if they're single, or $500,000 if they're married filing jointly, as long as they've lived in the home for at least 2 of the last 5 years. That inclusion has been in place since 1997, and home prices have more than tripled in many areas since then, meaning more and more middle-class homeowners are hitting that cap and facing the significant tax bills when they sell. Here's a real example of this. Say you bought a home for $300,000 10 years ago and the market pushed its value up to $900,000, a $600,000 gain. As a married couple, you exclude $500,000 of that, but the remaining $100,000 is fully taxable. At a 15% rate, that's a $15,000 tax bill on a house you lived in for a decade. The More Homes on the Market Act, a bipartisan bill with broad support, would double those exclusions for married couples, so they could shield up to $1 million in gains and adjust the limit annually for inflation. Under the proposal, your $600,000 gain on the same home would fall entirely under the new $1 million exclusion, zero tax owed. Trump allies has also floated an even more aggressive idea, exempting homes worth $2 million or less from capital gains taxes on the sale entirely. But as of mid-2026, none of this is passed yet. The home sale capital gains tax works exactly as it did before. $250,000 single, $500,000 married excluded. The rest taxed as long-term rates. Any changes requires constitutional action, and experts are calling it somewhat unlikely before the November elections. So what does all this actually mean for you right now? If you're a long-term investor consistently buying and holding index funds, the current law is already working in your favor. The 0% bracket for lower income earners and the 50% rate for most middle-class investors are generally favorable compared to the ordinary income tax rates. Inflation indexing would help, but it helps most on large gains held for long periods, not on monthly contributions most beginners are making today. If you own a home that has appreciated significantly and you're thinking about selling, the $500,000 married exclusion covers most situations. But if you're a high appreciated market and your gain is pushing past the cap, these proposals are directly relevant to your timeline, and may be worth watching how this develops before making a move. The broader point is this. Tax policy around investing in housing is actively in motion right now. None of these proposals are in law yet, but the conversation is serious enough that it's worth understanding exactly where things stand, so that when something does pass, you're not scrambling to figure out what it means for your portfolio. Stay informed, keep investing, and as always, talk to a tax professional before making any major decisions based on proposals that haven't been signed into law yet. Thanks for tuning in. Same pace next time. Keep compounding.